Guys, the PPI index, the producer price index numbers came in this morning, and they were a lot better than yesterday's CPI. Came in this morning at 0.2% versus the market's expectation of 0.3%. Also, February was 0.6%, so significantly lower than February's number. Now, if you remember, yesterday was the consumer price index, which actually came in higher and made markets tumble. Markets were up this morning to start, and now they're coming back a little bit. So you're probably wondering yourself, how do CPI and PPI work together? Well, PPI is the producer price index. Sometimes it's considered a leading indicator of CPI. Why is that? Well, the producers are the ones making the goods. If their cost goes up, at some point, they have to pass those costs on to the consumer. So maybe the consumer isn't paying it initially, but once those goods are made, if the producer's index goes up, they eventually have to increase the price, the end price for the consumer, which will then lead to the consumer prices going up. You see how that works together? So last month at 0.6%, kind of in line with this month's CPI report of higher inflation. Now this month, we have a lower one. Does that mean April will be better? It could be. Remember, in the CPI number, there's a lot of volatile things in there. Food and energy. In the core CPI, they exclude those to take out that volatility. Now, just like CPI has a core index, so does PPI. The PPI core index was supposed to be 0.2%, excluding food and energy, and it came in at 0.2%. So right in line. That tells me that food and energy did better than expected since, including food and energy, they were expecting a 0.3% increase. Now, if you're new to the channel, first off, welcome. And if you like this video today, please subscribe, because what we're trying to do here is make videos every week, several times a week, on actual things that are happening in the market as they happen. You're watching this video, and it was just recorded this morning, so please do me a favor, subscribe to the channel if you enjoy it. But guys, we talked about this. Back in December, there were calls for 6 or 7 rate cuts this year. Now, I'm not somebody who's going to guess what's going to happen. But I kept saying in videos, guys, if we have 6 or 7 rate cuts, what does that mean for the economy? Why would the Fed just cut rates for the reason of cutting rates? They wouldn't. You cut rates to spur growth. Why do you spur growth? Because there is no growth or things are suffering. You don't cut rates to spur growth because things are already awesome. That's inflationary. That's the very thing the Fed wants to fight. The Fed has 2 mandates: full employment and prices, okay? Price levels that's basically inflation. And at full employment, guys, we're sub 4% still. That's not full employment. That's way below. And when you have really low unemployment, that puts upward pressure on income. And when you put upward pressure on income, it drives up the cost of goods, which leads to inflation. So everybody out there who thinks that everybody making more money is a good thing, yeah, it's a good thing if it's in real dollars. But if we're just making more money to make more money, then it's going to be inflationary. This is why we don't have a $100 per hour minimum wage. If we did, then all of a sudden inflation would skyrocket, all the costs would jump up, and all of a sudden $100 per hour would be not a livable wage. And that's the whole point about when we talk about these economic things. Now, like I said, I'm not trying to make predictions on where the Fed's going to go. I could not care less. A lot of people out there use that as a reason to invest in X, Y, or Z. What I'm trying to teach here is understanding fundamentally a business that's going to do well in the long run. You have no idea where the markets are going to go. I've always shown, on many, many videos, I'll sit there and show this. You go back to 1982. The S&P was roughly 110. You go to 2024, the S&P is 5,000. In that time frame, what happened? Well, we had assassination attempt, we had Gulf War I, we had Bill Clinton's impeachment, we had 9/11, we had the great financial crisis, we had the dot-com crash, we had the real estate crash, we had catching Osama bin Laden, we had all these things, we had COVID, we had all these things happen. And in that time frame, the S&P went up almost 50 times. Why? Because fundamentally good businesses bought at the right price relative to value can grow and grow and grow. I want you to learn to make the right fundamental decisions by learning from our channel and from our community and software. But then it's all about having the emotion when the bad things happen that you stick along with it. You sit there and buy good companies at even better prices. That's what's key. What the Fed's going to do, the Fed's going to do. They're just going to react to what's going on out there. Their job is price control. They want to make sure the prices don't get sky high out of control. We got almost 10% inflation at some point last year or 2 years ago. That's a lot. That hurts everyday Americans every single day, and that's a problem. In this community up here, I love talking about the economy because to me, it's a great way of just understanding money. But remember, keep in mind, I do not make my financial investment decisions based on what the Fed's going to do, what the economy is going to do, or anything like that. Because guess what? At the end of the day, we have no clue. One of the big banks came out today and said, hey, we were calling for rate cuts back for February or March. Then they pushed it back to June. Now they're saying September, October. Guys, they have no clue. We went from 6 or 7 rate cuts this year to now maybe 2 by the end of the year. And guess what? We have no idea. We don't know what's going to happen. If all of a sudden there's a great economic calamity that makes like a COVID type of thing, what do you think they're going to do? They're going to absolutely cut rates, but they're not going to cut rates for the sake of cutting rates. And I look at the data on who watches our channel, and if you're like everybody watching our channel, you're age 25 to 45. If you're outside of that, that's awesome. Good for you for paying attention to things like this. But remember, especially if you're the younger side of that, 25 or 30, you've never experienced a real recession. Yeah, COVID was a recession, don't get me wrong. But when I say a real recession, a long 12, 18-month long slowdown where we didn't know when the job losses were going to end. COVID was relatively quick, and the government was writing checks to everybody to make sure they could pay their bills. But I'm sitting here saying, listen, the economy is going to do what the economy is going to do. And that's what makes it great. Because once you realize that buying investments based on their fundamentals and adding to them if the market price goes down is a great way to live. It's the great emotional way to live. You're going to make those fundamental decisions based on the data and the tools we provide here. But you're going to make a lot of money. And you're going to grow as an investor by keeping control of your emotions. I personally believe investing is 10 or 15% of the numbers. But guess what? 5 years ago, I thought investing was 100% about the numbers. It's not. A successful investor is somebody that can sit there and handle their emotions. Guys, in our community every week, I put a quote. And today's quote that I put in is from Warren Buffett. If you're emotional about investment, you're not going to do well. And guess what? I'm emotional about a lot of things. For some reason, I've trained myself over time to surround myself by the right-minded people, the like-minded people to control those emotions. And after learning from all the great investors and realizing what they did and how they did it, I had to brainwash myself. And that was a great, great thing that I learned. And that's why I created this community. I created this community exactly for that reason that we're in right now. So if you're interested in joining that community, click the link below. We're about ready to have a wait list. So before the wait list starts, make sure you get in. It's $7 for 7 days. Click the link below. I guarantee it'll change the way in which you view money and the way in which you handle the emotions of money. I cannot stress it enough that inflation is a real cost and it sucks. But at the end of the day, we have to sit there and understand what it means in the grand scheme of things. Everybody wants Fed Chairman Powell to cut rates. Why? Maybe we got spoiled by 2.5% to 3% home rates. Guys, we're at 7%. That's about historical. And guess what? There's some positives to that. Whenever you have higher interest rates, you have less dumb money chasing fewer and fewer deals. You know, we're in the real estate business as well. We have almost 1,000 units. 2 years ago, we would literally be told, don't even waste your time with that offer. It's not going to happen. Now, all of a sudden, we're in the running. The last 5 or 6 deals we've had, we've been in the final group. And we just got our first deal in a long time. And it's a big property, 200 units. It is a multi-8-figure property that we're buying. 3 years ago, we would have been just told, yes, scram. And the price would have been 20 or 30% higher. And now, because we didn't make the stupid assumptions everybody made, we realized that the rates at the time were not the going rate. That rates would probably at some point go back to the mean, revert back to the mean. Did I think it was going to happen that quickly? Absolutely not. But you saw that. Fed just went, okay, we're going like this with rates. And that's why you saw so many banks have problems. And those banks still have those problems. The only difference is the U.S. government has backstopped them and said, hey, we're not going to worry about those right now. So I want you to understand that there are so many different points that matter in the economy or that are brought up in the economy. How many really matter? I don't know. But I do like talking about these things because I think that as you sit there and understand how economies work, you can also understand how businesses work, and they all work together. So guys, if you're interested in investing and you want to see the 33 stocks that I'm going to own in the future, watch this next video. Thank you very much for your time.